Good. Okay. Hi, everyone. So, good afternoon, good morning, good evening to you. And thank you for joining the stream. Very much excited for having you once again. It's a new week, and we are continuing with our discussion on this series that we are working on in order for you to prepare well for your examination. So, welcome to the stream from everywhere you are. If you join the stream, give us a thumbs up on the video. Today we're looking at evaluating financial statements, or what is called ratio analysis, or if you want, interpretation of financial statement. This is a very critical area, a very fundamental area of the syllabus, and I want to take you through this so that you can make sure that the 20 marks that will be allocated to this particular topic, whether you're doing corporate reporting or financial reporting, SBR or advanced financial reporting, you will be in a better position to be able to get a higher percentage of that 20 marks to position you in order for you to prepare for the examination. So if you join the stream, give us a thumbs up on the video. That way we get more engagement on the video, and YouTube will be able to push the video so we can reach as much people as possible. But most importantly, let me know in the chat box if you have any questions for me. Put them in the chat box in relation to that. All right, I see some comments from the chat box coming in. Abiodan Ogunleki, good evening, Abiodan. MCA, hello, hi. John Edu, good afternoon, sir. Good afternoon, John. I believe you guys are doing well. Grace Defia McPop, good evening. I hope you are doing well, Grace. And then M. Seidu, I see you. Good afternoon, sir. Good afternoon. Kletos, I see you. Richard Amegashi, I see you. I believe you guys are doing well. And then Derek Esiama, I see you as well. Thank you very much for joining the stream. Gabriel Bemu, I see you as well. Welcome to the stream. So if you join the stream, give us a thumbs up on the video. On the main video page, give us a thumbs up. And if you know you have a colleague that has to join this stream and watch this lecture, come on, phone them or share the video with them on your Facebook pages, on your WhatsApp platforms, or your Telegram platforms. Let's reach as much students as possible as we look at a very critical aspect of the syllabus in relation to that. So we are looking at, I see Amma, Deborah, and Pim. You are welcome to the stream. Any questions for me before we get into our discussion for today in relation to that? Do you have any questions for me? Emmanuel Addison said, thanks a lot. God bless you, sir. Amen. God bless you too. I hope you're doing well. Andrew Beko, you are welcome. I see you. I believe you are also doing well. Any questions for me? Any questions before we go into our today's discussion? We're looking at evaluating of financial statements, or what we call evaluation of financial statements, or what you call ratio analysis, depending on where you are standing and how you want to look at it in relation to that. So any questions for me? Is there anything you would want me to talk about? You have anything, you can put it in the chat box for me. Maybe you are studying something you don't understand and you want me to clarify on it. Maybe you can put that in the chat box for me and I can assist you with that real quick as we prepare to gear into the evaluating financial statements. Okay, so I see some of you guys joining. Welcome to the stream, everybody. Please give us a thumbs up on the video. That way, the video gets more engagement and YouTube will be able to push it so we can reach as much students as possible. So together we can grow this channel and grow this community to become a one-stop center for people who are studying and preparing for their ACCA, ICA, CIMA, CMB, and other ones in relation to that. MCA said, "Sir, would you please assist me with the schedule for your sessions?" Okay. Details about each day's sessions are posted on my social media platforms. WhatsApp, we share on WhatsApp, and on my Facebook page at Nhyira Premium, and my Instagram account at Nhyira Premium. Details of the meetings are posted normally in the morning so that the students get the notification on what they should expect during our sessions in relation to that. So MCA, if you are not following me on Instagram or on Facebook, you can follow me, like my page on Facebook, because the session details or schedules are posted every single day in relation to that. Now, the reason why I don't share a full schedule for the period is that we design these sessions based on the questions you guys ask. Okay, so there are people who send us the email, who send us DM, who send us messages on WhatsApp that they want us to cover this topic, they want us to do this. So based on those kind of requests and where we see critical areas on the syllabus, these are how we design our sessions in relation to that. So MCA, I will entreat you to like my page on Facebook to be able to follow me, so that details of the meetings by 10 a.m. It's posted on my Facebook page or my Instagram account in relation to that. So that is it about our schedule. I see another question coming from Jamaldin Seidu. He said, under cash flow statement, is dividend paid treated under operating or under investing activities? Thanks. Now, when you're preparing the cash flow statement, dividend paid can be treated in two ways. One, it can be treated under the operating activities or under the financing activities. Dividend paid never comes under the investing activities. So dividend paid can either go to the operating activities or the financing activities. So these are the two spots that you can bring them, and either case, you are going to be right in relation to that. It is dividend received, income received. Those are what we classify under investing activities, but dividend paid strictly goes into the operating activities or under the financing activities. So you can decide which of these two spots or sections or segments of the cash flow statement that you want to bring dividend paid. Any other questions for me? So I see some of you guys joining the stream as well. Welcome to the stream. We're looking at financial interpretation of financial statements, or evaluating of financial statements, or ratio analysis in relation to that. So if you join the stream, do me a favor by giving us a thumbs up on the video for more engagement. And in case you've not subscribed to the channel, come on, what are you waiting for? Hit on the subscription button and the notification bell icon so that when I go live or release a new video, you will be the first person to be notified. Right, so let's get into our discussion for the day. Evaluating financial statements or ratio analysis. Emmanuel Addison said, please, can you talk a little of adjustments to changes in accounting policies and estimates? So that is under IAS 8. Okay, so Addison, let me mention that real quick in relation to that. Now, when it comes to changes in accounting estimates and accounting policies, you must understand how the application actually works in relation to that. Now, how does the application work at the end of the day? A change in accounting policy, the application is that we are going to do what is called a retrospective application. Okay, so when it's a change in accounting policy, we are going to do a retrospective application, which means that we are going to be going back to the comparative financial statements and adjust the financial statement. Usually it's going to be the previous year or the previous 2 years financial statements to enhance comparability. What it means with accounting, change in accounting policy is that we are assuming as though the entity had been using that policy previously in the preparation and presentation of financial statements. That is why we have the issue in relation to change in accounting policy. And so we do a retrospective application. But when it comes to change in accounting estimate, that one we do prospective application, okay? Prospective application, meaning that the effect or the change is going to be affecting current financial statements and then future financial statements in relation to that. So these are the concepts that you must understand in relation to how we deal with some items in relation to that. Foster Basios, I see you. You are welcome. Patience Pinkstill, good evening. I believe you are doing well. Augustine, hi guys. I hope you are doing well. Yes, Augustine, we are. I hope you are also doing well. Eric Aite said, have you resumed face-to-face classes at the Dacoman campus? Eric, currently for the May 2020 examination, we will be having our executive revision masterclass face-to-face with our students, with our protocols in place in relation to that. So it is from the next semester, certainly after this examination sitting, that face-to-face class may be resumed based on directives from the ICAG in relation to that. So currently, we are still having our lectures online, but our executive revision masterclass is coming on, and that is exclusively to our students. It's not open to the public, so exclusively to our students, and they will be coming on campus, and we will also be streaming the service on our study portal in relation to that. So Eric Aite, that is what you have to understand in that case. All right, so let's get into the day's business before it gets cold. Now, when it comes to the evaluation of financial statements, I want you to pay close attention to this topic very well, because today I want to assist you to understand this very important area of the syllabus from the perspective of the examiner. Now, I tell my students this all the time, that this area is one of the areas that is conc, meaning that we are certain that it's going to be there. We know that we're going to be computing ratios and interpreting the ratios. But students' weaknesses have been, or the weakness has been the interpretation of the financial statement. So let me give you some glimpse in relation to what's happening there. Financial reporting, corporate reporting. For those of you writing financial reporting, yes, the syllabus grading is still 20%. Corporate reporting, syllabus grading, 20%. Right. How are we going to have the exams in the exam hall? The examiner is going to bring a 20-mark question on the evaluating financial statement or ratio analysis or interpretation of financial statements. Corporate reporting students, you're still going to be having your 20-mark question in relation to that on the evaluation of financial statements or interpretation of financial statements. But the main question we need to ask ourselves is, what is going to be the structure of this 20 marks? How will the question be structured, and what do we have to do in relation to that? Now, when it comes to the exams, whether you are at corporate reporting or financial reporting, we are going to have a 20-mark question, like I mentioned. And this 20-mark question is going to be divided into two. We're going to have 15 marks on the calculation and interpretation of the financial statement, and we're going to have a 5-mark question, which is going to be a theory based. At least this is the current structure we understand based on the trial questions as well as the November 2019 examination. So financial reporting first, we're going to be having 15 marks on the calculation of the ratios and then the interpretation of the ratios. But this is where it becomes sweet. The calculation of the ratio is going to be just 5 marks, whilst your interpretation is going to be taking 10 marks. So students get excited about ratios, students get excited about interpretation of financial statements because they can compute. But they lose a lot of the marks on the interpretation because, as you can see, the marks is not on the calculation, the marks is ultimately on the interpretation of the financial statement. So it is your duty as a financial reporting student, as a corporate reporting student, to understand what is going on in the question, what is going on in the exams, to know that the interpretation of the financial statement is going to take a huge aspect of the syllabus or of your exams. So 5 marks for the computations, 10 marks for the interpretation. Now, the theory area may be about limitations of the ratios or any other question the examiner may want to pull up. Now, if the examiner gets exhausted, he may ignore this theory aspect, this 5 marks theory aspect, and just give you a 15-mark question on the evaluating or interpretation of financial statement, so that you can calculate and get a 5 marks and do the interpretation and get a 10 marks. Meaning that in a nutshell, evaluating of financial statements, you're going to be having 15-mark questions in relation to that. Now, if the examiner goes that route, it means that the other 5 marks will be taken to the question 5 session, which is going to be the theory on ethics, on conceptual framework, on accounting standards, or we'll take it to the question 2, the accounting standard segment of the syllabus in relation to that. So when it comes to the financial statement evaluation in financial reporting, that is what you got to understand. Calculation is going to be 5 marks. Your interpretation is going to be 10 marks. My objective today is to be able to wear the spectacle of the examiner and literally provide you with how the interpretation is supposed to be done so you can increase your chances of getting this 10 marks. I know a lot of you, almost everybody computes the ratio perfectly, but the issue comes in when it comes to the interpretation of the ratio. So I'm going to be standing in today and looking at it from the perspective of the examiner, what the examiner expects us to write, what the examiner expects us to talk about when interpreting the profitability ratios, when interpreting the efficiency ratios, when interpreting the short-term solvency and liquidity ratios, when interpreting the long-term solvency and stability ratios, as well as the shareholder investment ratio in relation to that. And so that is what we're going to be looking at in that case. So that is what happens in the financial reporting segment. In the corporate reporting aspect, the examiner is going to be some way on us. Last semester, he brought a 40-mark question on the calculation, and then we got a 6 marks question on the theory. Now, the 40-mark question was on the main ratio, and you were supposed to do a calculation as well as an interpretation in relation to that. Now, funny enough, the November 2019 corporate reporting paper, there were 3 years, or there was 3 years financial statement preparation for us, 3 years, and then you are supposed to compute the ratios for the 3 years. Now, this is what you got to understand. The computation of the ratios was 4 marks per the examiner's report, 4 marks for those computations, and you were supposed to compute profitability ratios, efficiency ratios, liquidity ratios, and the GRE ratios. So you were supposed to compute numerous ratios, and that was just 4 marks. So where do you think the large mark was? The 10 marks was on the interpretation. So you realize that whether you are doing corporate reporting, whether you are doing financial reporting, the computation doesn't take as much marks as possible, but rather it is the interpretation. It is for this reason why I want to come in today and assist you on how you can interpret the financial statement. My objective in this stream today and tomorrow, because we're not going to finish everything today and tomorrow, is to be able to give you that assistance so that when you compute the ratios, you can interpret the ratios. This 10 marks, you can get 8 out of the 10. You can get 9 out of the 10. Even if you get 7 out of the 10, you are in a good books, and it can position you to pass the exams in relation to that. So that is what we have to understand about the structure of the examination. Aside this, when it comes to the interpretation of financial statements, usually the examiner may request you to write a report or just an analysis. Last semester in the corporate reporting, the examiner asked students to write a report. So it was a report to the chief executive officer of the company, and you have computed all of these ratios, and you are going to be treating the ratios as an appendix, and then you write the report to the chief executive officer. Financial reporting students were just requested or required to just compute and then do an interpretation in relation to that. But please take note, the format of your interpretation will be based on what is happening in the question. So the examiner can say, write a report to the shareholders, write a report to the board of directors, or just analyze general in relation to that. And you have to understand the pro forma for reports, pro forma for memos, those kind of things. I think I've spoken about that before, and you should be in the position to be able to understand that in relation to that. So these are the things that you got to understand about the ratios. So let's kickstart and let's look at how we can begin the journey. Now, I'm not going to go through the theory of interpretation of financial statements, the limitations, those kind of things. You can read those things on your own. I'm not going to be going through those things that much. I see some of you guys joining. Welcome to the stream. Juliet, DD, I see you. You are welcome to the stream. If you join the stream, do us a favor with a thumbs up on the video. That way we get more engagement, and YouTube will be able to push the video so we can reach as much students as possible, just like you. And if you know some people who must watch this video and be part of this stream, share the video with them, call them up so they can join the stream in relation to that. Right, so generally, every organization at the end of the year would have to assess its performance to find out whether it is doing well or it isn't doing well. Now, if you're familiar with the balance scorecard, you know that there are various angles from which we can analyze the financial or the performance of the organization. So on the balance scorecard, we know that we are going to be analyzing the financial perspective. We're going to be looking at the customer perspective. We're going to be looking at the issue in relation to internal business perspective, and then learning and innovation perspective. So usually these are the 4 things in balance scorecard. That is not our main focus here. We are just going to be focusing on the financial performance or the financial perspective. Miriam, I see you. You are welcome. Basil, Akan, you are welcome. Basil, it's been a long time since I heard from you. I believe you are doing well. Miriam, you are not too late. I'm actually about to get into it. Isaac, idiom, I see. Did I say idiom? Sorry, okay. Isaac, Idwam. Forgive me if I pronounce your name wrong, okay? It's not intentional. And then Enyonam, Jandu, I see you. You are welcome. John Edu, my challenge has always been on the formula for investment ratios. Okay, don't worry, I'm going to be assisting you today and tomorrow. Richard Opoku Ajiman, I see you. You are welcome to the stream. Give us a thumbs up on the video. That way we get more engagement in relation to that. So if we are assessing the organization's performance on a financial level, we need to have a holistic performance of the organization on financial grounds. So a couple of ratios that will be computed in order to assess the financial performance of the organization will be the issue about profitability and return. So profitability and return. The second thing will be the issue in relation to efficiency. The third thing will be in relation to the short-term solvency, and liquidity. Long-term solvency and stability. And then the last one will be the issue in relation to shareholders' investment, which is what John Edu said it has been his problem. John, don't worry, we're going to be dealing with all of that. So shareholders' investment. So these are the broad category of ratios that we are going to be computing. Samuel Osei, I am here. All right, Samuel, I see you. You're welcome. So these are the broad ratios to be computed. We're going to be taking them one after the other, go through them, and most importantly, how to interpret. How to interpret. That is where my focus is. That is where my attention is going to be more in relation to that. Now, generally, the profitability ratios tries to assess, like the name suggests, the financial performance of the organization for the year ended under consideration. Now, it is either the financial performance of the organization, it's improving or it is declining. If it is improving, there are various factors that contribute to the profitability of the organization improving. It could be because of an increase in the sales. It could be because the entity is managing expenses well, or is controlling expenses well, or it could be because the entity is efficiently utilizing its resources to be able to generate more revenue in relation to that. So we are assessing that. Now, if the performance is also declining, it could be because sales is coming down. It could be because the organization is incurring more expenses, especially in this period of COVID-19. A lot of organizations are going to have a reduction in their profitability. As a matter of fact, a lot of companies will be making losses because some companies have increased or have reduced revenue or have lost revenue for about 75%, 80%, meaning that they are getting only 20% of revenue since the pandemic up till now in relation to that. But even though their revenue has decreased by 70 to 80%, they are still incurring expenses, because employees are still being paid. They are still paying other kind of subscription and other things in relation to that. So we need to assess the financial performance of the organization. That is what the profitability ratio seeks to do. Usually, our efficiency ratio and the short-term liquidity ratios tries to measure the efficiency and effectiveness with which the organization is managing its working capital. So the efficiency ratios, the short-term liquidity ratios, try to measure how the entity is managing efficiently and effectively the working capital of the organization. Why is this important, and why must we assess this? We must assess this because the working capital is the blood of the organization. The day-to-day running of the organization is dependent on the working capital. So at the end of the day, we want to find out whether the entity is properly managing, efficiently managing its working capital or inefficiently managing its working capital. Because if an entity is managing its working capital very well, it means that they will have an improved liquidity and short-term solvency, and that means that they will be in a better position to pay their short-term debt as and when they fall due. However, where the entity is inefficiently managing its working capital, it means that short-term debt, when they fall due, the entity may be having issues paying them in relation to that. So at this level, we want to assess how many days do we give to our customers to pay for the goods that we sell to them. You got to be careful about all these. When I get to them specific, I'm going to be explaining them deeper, but assessing the efficiency and then the liquidity ratios will depend on the industry that we are in. And I want you to make sure you stay with me when we get there in relation to that. Because for instance, if we are a construction company, then the payable days may be high, the receivable days may be also high. If we are a retail company, the payable days may be in the medium level, but the receivable days may be reduced to a very short days, because for retailers, they may not be giving much in relation to that. If you're an educational institute, the management of this is also going to be different in relation to that. So in the assessment of the organization, you don't just get up and start writing. You must be careful of the industry that company is in so that you can use the industry's information to be able to analyze the financial statements in relation to that. Then we come to the long-term solvency and stability. This is where we talk about the gearing of the organization, that is looking at the capital structure of the organization to identify whether the company is highly geared or not geared. Now, why is this important? This will be able to assess or enable the company to look at raising finance either from the debt holders or from equity holders. And also it will guide the equity shareholders to either demand more return on their investment or maintain their returns in relation to that. Because if the capital structure of the organization is such that the gearing ratio is high, that is going to be issue in relation to that. Patient said, please say, what have you captioned in blue? I said working capital management. That is WCM, working capital management. I mentioned that the efficiency and the short-term liquidity assesses the working capital management. So long-term solvency or stability, it's also critical for the organization in relation to that. But in order for us to explain whether the gearing is too high or too low, we must look at other ratios like the interest cover ratios. Because if the gearing ratio is going up, that doesn't mean you say, hey, the company is highly geared, the company will be facing going concern problem. No, a company can be highly geared, but once its interest cover, it's also increasing or it's very high, that means the organization is not having a problem, because it means that they are utilizing the loans very well in relation to that. But we've got to also understand some other issues when it comes to the interpretation. Like for instance, if your capital employed is increasing, but you realize that your revenue is falling, that is an issue in relation to that, meaning that possibly you are going for the loan, but probably you are using it to pay operating expenses, using it to pay some other recurrent expenditure in relation to that. So enough of the talking. Let's get into them one after the other, and let's look at the interpretation for them one after the other. This is where I want you to follow me carefully, please. And if I explain something and you don't understand, please indicate in the chat box. This is an interactive discussion, so you put it in the chat box and I could go over the rate for you in relation to that. Wanami Godwin, I see you. Patience said thanks. You are welcome, Patience. So let's go. Starting with profitability ratios. So when it comes to the profitability ratios, there are a number of ratios that we can compute in relation to that. Please note that there are sometimes, usually, the examiner will ask you the kind of ratios you should calculate, especially in the financial reporting area. But sometimes the examiner can also be quiet and you have to use your head there to be able to know the kind of ratios you have to calculate in order to assist you to have a holistic interpretation of the financial statement in relation to that. Okay, Basil Aiken said, please, what of shareholders' investment? Okay, now the shareholders' investment ratio is assessing the returns that shareholders are actually making on their investment at the end of the day. So profitability is looking at, yes, how are we doing as a company? Are we profitable? What is our financial performance during the year under consideration? Efficiency and short-term liquidity is looking at the issue in relation to how we are managing our working capital management, or how we are managing our working capital. And then the long-term solvency and stability is about your gearing, whilst the shareholders' investment ratios assesses the returns that the shareholders are going to be having. Because you see, at the end of the day, shareholders are putting money into the business. So if shareholders are putting money into the business, they want to find out how much returns are we making? Okay, how much dividend is the company paying? So you're going to be looking at things like dividend per share. Okay, how much earnings are we making? Earnings per share, so that they can assess the percentage of profit that has been retained by the organization. Then they can find out, okay, what is the PE ratio of the organization, and that will predict the future earnings potential of the organization. So the investment ratios, among other things, it's strictly for the investors, shareholders, and potential shareholders to assess, okay, the organization may be making profit, but how much are we making as an organization? And what is our future earnings potentials? That kind of question is answered by looking at the shareholders' investment ratios in relation to that. And like I said, we'll be getting into all of these in that case. But in a simple language, the PE ratio assesses the future potential of the organization to pay its shareholders the earnings that they need to pay in relation to that. So Basil Aiken, I believe I answered your question. Florence Mensah, I see you. You said, thanks, sir. You are welcome. Florence Mensah. All right. So let's look at the profitability ratios. Okay, Basil said, thank you very much. You are welcome, Basil. If you're watching and you have any question on something I said that you don't understand, don't hesitate. You put it in the chat, because I'm reading all of your comments, and we'll be replying to them live in relation to that. So let's look at the profitability ratios, and let's look at how we're going to be interpreting the profitability ratios. So when it comes to the profitability ratios, like I mentioned, there are a couple of ratios to be computed in relation to that. The traditional one that we go for, now when I say traditional, it doesn't mean we are pouring libation, all right? It's the ROSI. ROSI is simply your return on capital employed. Now, this ratio assesses how much return the entity is making for every $1 of capital invested. How much profit is being made from every $1 of capital invested. The standard states that, now when I say the standard, I don't mean any IFRS or IASs, but the standard is that the higher the ROSI, the better it is for the company. The higher the ROSI, the better it is for the company. So our ROSI could be computed using the profit before interest and tax, divided by capital employed times 100. Profit before interest and tax divided by capital employed times 100. Please note that there are other times when, if you don't have the profit before interest and tax, you can use the profit for the year in the computation of the ROSI. It's allowable. It's allowable. Now, for those of you writing corporate reporting to be specific, the examiner may request that you make an adjustment to the profit before interest and tax. Now, the examiner is not going to say this exactly, but he's going to be giving an additional information to the extract of the financial statements you've been given, and you may have to adjust the profit before interest and tax before you calculate the ROSI for comparative purposes. Because if, for instance, in the current year under consideration, the entity sells an asset, or the entity derecognized an asset as a non-current asset to a current asset as a held for sale, it means that an asset has been transferred from being accounted in accordance with IAS 16 and now being accounted in accordance with IFRS 5 asset held for sale. That means that we cannot use this capital employed to compute the current ROSI and compare it with the previous year ROSI. There has to be an adjustment to the financial statement before we can do that computation in relation to that. So you've got to be careful even about the computation, whether you need to make an adjustment in order to enhance your interpretation. Now, when it comes to the capital employed, there are two ways the capital employed can be computed. I see a comment from Daniel Chirawura. She said, thank you for this. You are welcome, Daniel. Give us a thumbs up on the video if you join the stream. That way we get more engagement on the video. I see some of you joining. You are welcome to the stream. If you have any questions, please put it in the chat box for me. I'm reading all of your comments and I'll be answering them in real time. So your capital employed can either be your total assets minus current liabilities. Total assets minus current liabilities, or your capital employed can be your shareholders fund plus long-term debts. Now, please follow me here well. Follow me here very well. So your capital employed can either be your total assets minus current liabilities, or the shareholders fund plus the long-term debt. Please note, there are times when in the financial statement, you will see leases of assets. Leases of assets. Now, where there is leases of assets, usually the non-current liability lease obligation will be included in the determination of the long-term debt. Let me take that again. If there is leases in the question or on the face of the financial statement, if we are determining the long-term debt, the leases will be included in the determination of the long-term debt. When I say leases here, I mean the non-current liability of the lease obligation, not the current, but the non-current will be part of the long-term debt in relation to that. So that is the issue about the long-term debt. Now, for shareholders fund, you know the things already: stated capital, retained earnings, share premium, reserves, and any other items could be under the issue in relation to the shareholders fund. This is where I was mentioning that assuming an asset was derecognized during the year, or there are any adjustments to be made during the years, it could be occurring in the financial statement in relation to that. So these are the two ways we compute the capital employed. And it could be total assets minus current liabilities, or shareholders fund plus long-term debt. And remember the components that I added to the long-term debt. Olanihi Abdullahi, I see you. You are welcome to the stream. Thank you for the thumbs up in the chat. Give me a thumbs up on the main video page as well in relation to that. I see some of you joining. Welcome to the stream. I'm very much excited for having you guys around in that case. So we computed the ROSI. And so what? What does it mean? What does it represent in relation to that? So when we compute the ROSI like this, it has to be interpreted. So if the ROSI is going up, what does it mean? If the ROSI is coming down, what does it mean? So I want to illustrate to you what is happening here, because we will be looking at it in isolation, then we look at them together in relation to that. So let's pull a preamble up. Not really a preamble. I'm just going to cook some figures here to enable us. So let's say we have 2 years. Let's say we got 20x9 and 20x8. So we computed the ROSI, and let's say 20x9, which is the current year, it's 25%. And then 20x8, it's what? Let's say 18.5%. So how do we interpret this? How do we interpret this? Okay, I see a comment from Patience. Patience said, please restate the lease again. Okay, what I mean is that as part of the long-term debt, there may be leases in the question. So if there are leases in the question, the non-current liability of the lease component will be added, all right, to the long-term debt. So when you take your long-term debt, bank loan, long-term bank loan, debentures, or whatever you have, then you add the lease obligation, the non-current liability of the lease obligation is added to this in relation to that. So patience, that is the concept about that. Isaac said, what about deferred tax under non-current liabilities? Okay. Usually deferred tax will be included, the reason being that it's not just this year, it's coming from the previous year in relation to that. So usually deferred tax are included in the statement. So usually deferred tax will be included in the computation in relation to that. Mohammed said, good evening, I'm late. Yeah, Mohammed, you are late small, but don't worry. M said, you said, we lost you, sir. No, you didn't, I'm here. Patience, I hope you are okay with the explanation I gave on the lease part. Gabriel, sound is lost. Okay, Gabriel, sound is on. I believe you can hear me now. Okay. So let's say we have this information. Now, this is where I want you to focus on, right? When we are interpreting generally the profitability ratios in general, let me give you some general principles on that before I come to the ROSI. When we are interpreting the profitability ratios, there are certain things the examiner expects us to be using in the interpretation. Either we are doing them individually or we are doing them together. Now, there is always going to be a change in ROSI, a change in assets turnover, a change in the net profit margin, a change in the gross profit margin. There is always going to be a change. But the question we ask ourselves is, what causes the change in relation to that? So when we are doing the interpretation of the financial statements, there are a couple of things that we need to take note of, and that is what I want to put here even before we go through to the ROSI extracts that I have there. So one, we first have to look at, now this is what we mention, or this is what we talk about in relation to that. Gabriel Prince Arnaud said, good evening, sir. Please, I can't get, I don't understand, Prince. You can retype. I didn't get that. Gabriel said, can you repeat the bit on deferred tax? Yeah, I mentioned that usually deferred tax, we would include it as part of the non-current liabilities with the assumption that the deferred tax is the same, it's part of the company's liability coming from previous year to the current year in relation to that. So usually we don't adjust that in the preparation of the financial statement in that case. It's rare cases where the deferred tax may be adjusted, especially in the determination of the capital employed. But usually it is not adjusted in relation to that. So when we are interpreting the financial statement, this is what we see students do. And this is what I wanted to pay close attention to. And the ROSI has increased from 18.25% to 25%. This means that the performance of the organization has improved. No. That's KG2 talking. Yes, the performance has improved, but give us some solid nuggets. All right? Give us some solid nuggets. That's what we're looking for here. So how do we assess the question in relation to that? Prince Arnaud said, please, I need try question, please. Try question on what? Maybe you can WhatsApp us later on if that could be made available for you. So when we are interpreting the financial statement, there are some benchmark rules. Number one, tell us about the percentage change. That's the first thing. The percentage change. So don't just say the ROSI has increased from 18.5% to 25%. Yes, we can see that. But tell us the percentage change. So in your interpretation, you don't just say ROSI has increased from 18.5% to 25%. No, you tell us that ROSI has increased by an X percent. So the percentage change in relation to that. Then you need to ask yourself or tell us as part of your analysis, what could be the possible causes? So if there has been a change, what could be the possible causes to the change or for the change that has been recorded by the organization? What could be the possible cause? Is it that revenue is going up? I'll come back to that in a moment. And then the last aspect is the possible future implication. This is what the examiner wants you to do for the 10 marks. So make sure you get it well. So when interpreting profitability ratios in general, and some of this may cut across when we go to the efficiency and then the investors ratio as well though. So the first thing is the percentage change. The second thing is the possible causes, and the third thing is the future implication. Now, why are we interested in the percentage change? Because it is critical for us to find out whether the percentage change is higher or lower. So don't just tell us it has increased from 18 to 25, but the 18 to 25, what is the percentage change? That is the first thing you do all the time. Now, how do you compute the percentage change? The percentage change, that's going to give you 25 minus 18.5 divided by 18.5 times 100. And so in this case, my percentage change is about 35.1%, something like that. 35.1%, that is my percentage change in the revenue, in the ROSI in relation to that. So that is the concept. You find out that and you use that in your interpretation in that case. Then the possible causes. What could cause our ROSI to rise, or what could cause our ROSI to fall? Please note that when you are interpreting the financial statement, chances are you don't have all the information available. So you have to be very strategic in relation to the statements that you make in the analysis. Jonas, I see you. You are welcome. You have to be strategic in the interpretation of your analysis. So what are the possible causes? Remember I told you about we stating the possible causes. So what are the possible causes? So the possible causes can include the following. One, a change in revenue. That could be a possible cause. Two, we can talk about a change in cost of sales. Three, we could talk about a change in operating expenses. Then four, we could talk about a change in the capital employed, especially when we are dealing with the ROSI. When we are dealing with the ROSI in relation to that. So change in revenue, change in cost of sales, the change in expenses, change in capital employed. These could be the possible causes for the ROSI increasing or decreasing for the organization. Now, future implication, Abiodun said, can you take that, how to get a percentage change? The percentage change, usually this is what I do, the bigger figure minus the smaller figure divided by the previous year's figure in relation to that. So in this question, we have the current year to be 20x9 and the previous year is 20x8. So our percentage change will be 25 minus 18.5 divided by 18.5. So that will be how we will times 100, certainly, and that's how we get the percentage change in relation to that. Does it make sense? Abiodun. So these are the four. I could add some of them as we continue. So the changes in revenue, changes in cost of sales, changes in the expenses, and then changes in capital employed, especially if we are dealing with a ROSI in relation to that. Future implication tells us what is going to be happening in the future. Now, this is something you've got to understand. Usually, many students will be able to talk about the percentage change. We'll tell about the possible causes, but the future implication, you could bring it under the conclusion. Because remember, any analysis you are writing, whether it is just an analysis or a report, you must bring a conclusion. So the conclusion that you are bringing at the end of the day, the conclusion you are bringing, you can put the future implication there. that, for instance, if ROSI is falling, what is the future implication? If your asset turnover is falling, what is the future implication? The future implication could be that the entity is underutilizing its assets and may not be able to prepare or pay for loans, short-term debts as they when they fall due, or the entity is not generating more as revenue. So going into the future, if the entity doesn't find ways to generate more revenue, then it has to sell some of its surplus assets or do a reorganization in relation to that. So three core things we want to see in your interpretation: the percentage change, the possible causes, and future implications. Like I mentioned, you don't necessarily have to bring the future implication under each of the ratios. You could bring that under conclusion paragraph in relation to that, where you put all the pieces together and then you talk about what is happening to the company and what will be happening to the company going into the future in relation to that. So that is what you need to understand when we talk about the issue in relation to the interpretation. So percentage change. So like I said, don't write, and ROSI has increased from 8.5% to 25%. It means the performance of the organization has increased. And so what? Tell us the percentage change. That is a better way to do an analysis. Tell us the possible causes. Okay, yes, performance has increased. How do you know performance has increased? Okay, revenue has gone up. How do you even know that revenue has gone up? Probably revenue has gone up because the trade receivable days may have gone up, meaning the company is selling more of its goods on credit. That is why the revenue was up, or the asset turnover was up. Now, you can see I'm already getting deeper on the interpretation by merging some of them. And this is also a challenge for many of you in relation to that. But stay with me. I'm going to be taking it bit by bit in relation to that. Basil Aiken said, please explain how change in capital employed can result in change in ROSI. Okay, I'm coming to that in relation to that. So with my illustration that I have here, I will say that, all right, profit has gone up, or ROSI has increased by 35.1% from 2008 and 2009. This could be due to increase in revenue, reduction in the cost of sales, or reduction in operating expenses, or it could mean that expenses are being controlled by the organization in relation to that. But this is a trick you must understand. I know, okay, for those of you who don't know, there is what is called creative accounting, window dressing, and those things. There is a way that if divisional heads or managers realize that their performance will be recognized or will be analyzed using the ROSI, there is a way the capital employed can be manipulated so that the ROSI will go up in relation to that. So let's look at how a change in capital employed will affect the ROSI, and let me explain that to you in relation to that. So let's say we have 2 years, okay? So 20x5, 20x4. Let's assume that profit before interest and tax, and then capital employed. So let's say in the first year, profit before interest and tax, we are having like, say, 200 million. Let's say here, we are having like 240 million. Let's say for the capital employed for 20x5, we are having, let's say, 1,200 million. And let's say here, the capital employed has fallen in relation to, say, 750 million. Now, I want you to look at what is happening here, and let's find out how capital employed can impact the ROSI. So having this in mind, let's see how the ROSI will be computed. Let me grab my Casio. Give me a moment. Let me plug my. Okay, so let's calculate our ROSI. 200 over 1,200 times 100. That's around 16.7% for this one. And then let's see for 20x4. $240, 720, sorry, 750 times 100, and that's 32%. So I want you to see what is happening here. See what's happening here. You realize that profit before interest and tax was 200 million. Capital employed was 1,002, and so there the ROSI was just this. But profit has increased, and look at how ROSI is increasing. ROSI is increasing approximately about 100% with the reduction in the capital employed. But you can see that the profit before interest and tax, it's increasing by only 20%. So whilst profit before interest and tax is increasing by 20%, your ROSI is increasing by approximately 100%. What is happening there? It's because of the issue in relation to what? The capital employed. So what we're saying here, or what I'm illustrating here, is that, maybe let me change the year, 5 year and then 4 year. I just want to do an upward thing to do my illustration. It could be downward though, but I prefer an upward for my analysis. So let's say the company wants to increase its ROSI. The company can decide to do some off-balance sheet finance. So remember I told you leases must be included in the capital employed. They may decide not to include it. Or there is a loan, they may decide not to include it. Or what it means also is that probably during the year, the company repaid some of its loans. Or during the year, the company repurchased some of its shares. So when your capital employed falls, your ROSI actually goes up in relation to that. So when we are interpreting ROSI and ROSI goes up, you don't just say ROSI has gone up because your sales has gone up. You don't just say ROSI has gone up because your cost of sales may have fallen. You don't just say ROSI has gone up because your operating expenses has fallen, but it could be because there is a reduction in the capital employed, because just a slight reduction in capital employed could result to an improvement in the ROSI in relation to that. So, Basil Akan, this is how the ROSI affects it in relation to that. Augustine said, though I have already passed FR, it's also going to help me in management accounting. Thanks. Yeah, that's very true in relation to that. So that is how we deal with the ROSI. I believe you understand the computation, the element. The interpretation is my focus. So we say that ROSI has increased by the percentage change. Then what could be the possible causes? All right, increase in sales, reduction in cost of sales, reduction in expenses, or a reduction in the capital employed, because all of these things can improve the ROSI in relation to that. So that is what you have to understand when it comes to the ROSI. But you see, These standards are not islands. In other words, they are interconnected. Just a moment ago, when I was explaining Rosie, you remembered I mentioned asset turnover, and I was talking about the trade receivable days. So the standards are interconnected to each other. So one standard that is, the ratios are interconnected to each other. So one ratio that is connected to each other is, or that is connected to the Rosie, is the asset turnover. So let's go to the second one, asset turnover. In a nutshell, we said the Rosie measures the rate that the entity make, the returns that the company is making on every $1 of assets invested or employed. And we said the higher the returns, the better it is for the company in relation to that. Basil said, thank you. Samuel Quasin, I see you. You are welcome. So let's go to the second one, asset turnover. Now, okay, I see a question from Dennis. Dennis said, please, what are some of the issues that can increase profit greatly whilst capital employed reduces? I have mentioned this already. Increase in revenue can increase our profits. A reduction in the cost of sales can increase our profits. A reduction in operating expenses can increase our profits. Now, when we use the word reduction here, it doesn't mean the entity is consciously reducing it, but it could mean that the entity is well controlling the costs. So even though revenue may be going up, costs may be well controlled so that the entity may be enjoying some economics of scale. So when revenue goes up, definitely your profit goes up. When your cost of sales fall, your profit goes up. When your operating expenses also fall, your profit also goes up in relation to that. So when expenses are well managed or controlled, that's the best word, well controlled by the organization, certainly the profitability goes up in relation to that. So Dennis, I believe you are okay with that. So let's go to the asset turnover. Now, when it comes to the asset turnover, now turnover means sales, okay? So asset turnover simply measures how much sales is generated from every $1 of assets employed or capital invested. Asset turnover measures how much sales is generated from every $1 of assets employed or capital invested. So in a simple language, our asset turnover will always going to be our sales or turnover, if you want, divided by the capital employed. Now, the results will be X times, like it goes with times in relation to that. So what are we talking about with asset turnover? Usually, asset turnover, if for instance your asset turnover it's increasing, it should mean that your return on capital employed should also go up. Because if you are generating more revenue from your capital employed, then you should be making more profit from your capital employed. But this is the sweet spot. It could be the opposite. So how do you interpret this? Again, when you are talking about the asset turnover here, you need to talk about the change, all right? So maybe year one, it is 5 times. Year two, it was 8 times. So you got to look at the change that came in relation to that. Then what could be the possible causes in that case? Now, remember what I mentioned. If your asset turnover is going up, it could mean that because it is just about sales we're talking about here, it could mean that your sales is going up. So changes in sales, or it could be that your capital employed is also changing here. So your asset turnover going up could mean your sales is going up or your capital employed is falling. Because remember, just like the ROSI concept, the same thing apply here. When your capital employed falls, ROSI goes up. So the same thing happens to the asset turnover. When your capital employed is falling, your asset turnover will be high in relation to that. I see a comment from Augustine. He said, reduction in sales returns could also increase sales revenue, hence increase in profit. Yes, that is true. A reduction in the sales returns will increase the sales revenue in that case. So we increase profit in that case. Yeah, so that is an operational decision in relation to that. So meaning the quality of our product is on the top notch so that people don't buy and return them, then certainly we're going to be increasing our profits in that case. So if your asset turnover is up, yes, it means sales is up, or capital employed is down. Now, how do you determine this in relation to that? Usually, if the sales is up, we need to confirm whether it is a cash sales or credit sales in relation to that. So another indicator that will help us to interpret the asset turnover well is to look at the trade receivable days, which is under the efficiency ratios. And I'll explain that when we get there, but I'm bringing it here in relation to that. If your trade receivable days is going up and your asset turnover is also going up, then it will confirm that yes, the asset turnover going up is due to increase in the sales, and there is increase in the sales due to the increase in the trade receivable days. Because what it means is that we are giving more favorable terms to the customers. That is why they are buying more. So most of these sales we are having are not really, or were not really cash sales, but they were credit sales in relation to that. So that is a relationship that we can connect with the asset turnover and then the trade receivable days. Then let's come back to the connection in relation to the asset turnover and then the ROSI here. So like I mentioned, if there are any questions, please put them in the chat box for me. If you are watching the video, give us a thumbs up on the video. That way we get more engagement on the video. And in case you've also not subscribed to the channel, come on now, subscribe to the channel and become a VIP member that way. Anytime I go live or release new content here, you'll be the first person to be notified so you can study under my mentorship and pass your exams in that case. That doesn't mean if you don't learn under me, you won't pass. You will still pass if you work hard. So asset turnover is up. We expect ROSI to be up. But what if asset turnover is up and ROSI took a nose down? That is, ROSI is falling. So your asset turnover is up and your ROSI is falling. What is the relationship here? If your asset turnover is up and your ROSI is falling, what it means then is that even though the entity is generating more sales, even though the entity is generating more revenue from the utilization of assets, the entity may not be controlling its expenses well, and hence the fall in the ROSI. Let me take that again. Your asset turnover is going up, but your ROSI is taking a nose down. It's reducing. What it means then is that even though the entity is generating more sales, even though the entity is generating more revenue from the utilization of its assets because of the improvement in activities, the ROSI is falling because the expenses are not being well controlled by the organization. So it could be that there is increase in cost of sales, there is increase in operating expenses, or there is increase in some administrative expenses in relation to that. That is how we interpret it in that case. So again, you see that There is a relationship. And this relationship is critical. It has to be drawn when you are making the analysis so that we know you are not just chewing baba. Because remember, this is not just preparing you for the exams for you to pass and go away. It is for the corporate or organization, all right? So at the end of the year, your boss calls you and say, Dennis, calculate the ratios and write a report on our performance and let me see. Then now you're going to do research. No, you've got to know these things like off head, and they are very simple. Okay, they are very, very simple. So this is the second ratio you need to understand, the asset turnover. The asset turnover. Now, there are times when the reverse can also happen. Your asset turnover is falling. Look at it, but your ROSI is going up. Asset turnover is falling, the ROSI is going up. Now, if your asset turnover is falling, it simply indicates that there is a drop in the trading activities of the organization. In other words, the entity is not utilizing its assets well. That is why there is a fall in the revenue. That is why there is a fall in the activities of the organization. Hence, they are not generating more revenue. So the asset turnover is falling. But your ROSI is going up. So even though there is a drop in the trading activities, or we are not generating more revenue, or assets are not being utilized well, there is an increase in the profitability. There is an increase in the ROSI. Why? It could be because expenses are well controlled by the organization. That is why even with a fall in our revenue, with a fall in our trading activities, we are still able to make profit in relation to that. So this is how you do the interpretation in relation to connecting the asset turnover and then the ROSI. If you are able to do this connection in the exam hall, the examiner will fall in love with you at once. He will fall in love with you at once because it is critical, it is fundamental. It's only a few students who are able to do the connection. Among these few students, I hope you are, and you're going to be doing that. Any questions so far for me? Put them in the chat box for me. Any questions? Any questions for me? Maybe an interpretation you don't understand, or I made a statement that doesn't really resonate with your previous knowledge, or something you understand about the standard or about the ratio, and you could point it out real quick, and then I'll look at it for you. Now, aside these two, there are other two ratios that are still in profitability ratios, and that is the gross profit margin. The gross profit margin. Now, in a simple language, the gross profit margin simply answers or tries to measure the percentage of returns that a company is making after cost of sales is less from the revenue of the organization. So when we less revenue, when we less the cost of sales from the revenue, how much profit are we making at the end of the day, even before our operating expenses? As the rule states, the higher the gross profit margin, the better it is for the company, and the lower the gross profit margin, the worse it is for the company. So ideally, we expect the gross profit margin to be increasing from year to year, which means that the entity is well controlling its cost of sales. And that could be due to the fact that the entity is buying in bulk and enjoying some economics of scale, or the entity is increasing its revenue. That is why the gross profit is going up in relation to that. At the end of the day, how much returns are we making? Should we take our cost of sales from the revenue even before dealing with other operating expenses? So our formula is going to be the gross profit divided by your sales times 100. Gross profit divided by sales times 100. That is our gross profit margin in relation to that. Like I mentioned, the higher, the better it is for the company. Usually, what is going to be happening is that the gross profit margin may be falling or increasing to the other ratios. But our interpretation of the gross profit margin will usually be earmark or benchmark on a couple of things like the change in the sales, as well as the change in the cost of sales. So it could be because of the change in the sales or the change in the cost of sales in relation to that, like I mentioned earlier. And the change in the sales could be confirmed with the asset turnover. So if your asset turnover is going up and your gross profit margin is also up, then it tells you that, yes, the gross profit margin is up because of the increase in the revenue, because of the increase in the asset turnover in relation to that. But if your asset turnover is going up and your gross profit margin is falling, it tells you that even though the entity is generating more sales, the entity is incurring a lot of cost in selling of the goods. And that could be issues in relation to discounts. It could be issues in relation to some issues in relation to purchases that we make from our suppliers in relation to that. So your asset turnover is going up, meaning you are generating more revenue, but your gross profit margin is falling. It means, yes, revenues are going up, but your cost of sales is actually going up in relation to that, which suggests that the cost of sales are not being controlled by the organization in relation to that. On the other hand, if your asset turnover is falling and your gross profit margin is going up, it tells you that the entity is sustaining or well controlling its cost of sales, probably by buying in bulk to enjoy some economics of scales in relation to that. That is why the gross profit margin is increasing in that case. So these are also some of the things we take into consideration when interpreting the gross profit margin. Any questions, please put it in the chat box for me. Then the last one will be the net profit margin. The net profit margin. So the net profit margin tries to measure, just like the gross profit margin, how much profits the entity is actually making from sales. You see, this is the idea. Let's say your selling price is $200. So I'm selling this calculator and it's $200. And to sell this calculator, I need to incur or pay some commission. So the commission that I'm paying on it is, let's say, $30. Meaning I'm making a gross profit of, say, $170. So when I divide that 170 over the sales, it means I'm making a return of over 85%, and that is great in relation to that. But let's say that for us to actually take this calculator to the sales executive or actually do the delivery to the customer, we need to pay some delivery cost of, say, $42. Which means that even though my gross profit is 170. When I take out the delivery, I'm going to be having a net profit of somewhere around 170.42. That should be 20. 128, and that is my net profit. Now, if you check it out, 128 over still the sales of 200, I'm going to be having 64%. So even though my gross profit is showing an 85% returns, my net profit will be showing something like 64% in relation to that. It tells you that we are incurring the cost, more cost on delivery in relation to that. So that's the difference between the gross profit margin and then the net profit margin. So like I mentioned, the net profit margin, still looking at the returns, but this time around, we are looking at the returns from the perspective of the fact that after we take other expenses from the gross profit, how much is left for the organization in relation to that? Usually, we still use the profit before interest and tax divided by the sales. Like I mentioned earlier, sometimes we could use the profit for the year. But the reason why the profit before interest and tax is always preferable is because interest expenses paid from year to year varies, and then the tax liability from year to year also varies. But remember, we are doing comparison. So we want to look at a benchmark, and so the benchmark will be, okay, let's use the profit before interest and tax. That is why preferably we go for the profit before interest and tax rather than using the profit for the year. But like I mentioned, if you don't have the profit before interest and tax in the question, then you can use the profit for the year. But there are ways you could compute the profit before interest and tax. Sometimes you may not have the profit before interest and tax, but you have interest, you have tax. You could add those figures back to the profit for the year, and you'll be able to get a profit before interest and tax, and that will enable you to compute your net profit margin. Again, when it comes to the net profit margin, the higher the net profit margin, the better it is for the company, and the lower the net profit margin, the worse it is for the company in relation to that. So a change in the net profit margin, as always, we're going to be bringing the change. And so what could cause the net profit margin to change? Number one, we could talk about the change in the sales. We could talk about change in cost of sales. And definitely we could talk about changing the operating expenses of the organization. So these three components could contribute to the issue in relation to what is actually happening to the net profit margin in relation to that. So these are the four key ratios that we can talk about when we talk about the issue in relation to profitability. Again, please note, in our interpretation, we'll bring the percentage change. Number two, the possible causes. Either there is a change in sales, there is a change in cost of sales, there is change in expenses. Then the future implication, like I mentioned, you can bring it individually or you can bring it as a conclusion when you are writing your report or making your analysis in relation to that. Any questions for me, please, so far? Any questions for me so far? If you have any questions, you put it in the chat box for me as I help you with them. Any questions, or are we good to go? All right. So dealing with profitability ratios, these are the things we look at. These are the things we talk about. Remember, like I said, the computation, it's like 5 marks for the corporate reporting, 4 marks, sorry, 5 marks for financial reporting, 4 marks for corporate reporting. So your problem will always be in the interpretation. Now, this is what I want you to do. Get a question on ratios and compute the ratios and then practice the interpretation. Remember, one of the things I've mentioned. Okay, I see a question from Derek CIMA. He said, please, how do we link the NPV and asset turnover with regards to the interpretation? Okay, good. I guess I didn't talk about that. It goes with the same approach. The asset turnover going up on the average could mean that our net profit margin should also go up. Okay, so if the asset turnover is going up and the net profit margin is going up, then it confirms that the net profit margin is going up because of an increase in the sales during the year under consideration, right? But the reverse can be true. It could mean that the asset turnover is going up, but the net profit margin is falling. What it means is that even though the entity is utilizing its assets, even though the entity is generating more revenue, the entity is not able to control its cost well. Hence, there is increase in cost of sales, increase in operating expenses. Possibly that was why the net profit margin fell in relation to that. Then, if your asset turnover is falling and then your net profit margin is increasing, what it means is that even though assets are being underutilized or there is a drop in the activities of the organization, the entity is well able to control its expenses. That is why the net profit margin increased in relation to that. So Derek CIMA, that is the answer to your question in that case. Does it make sense? Let me know if it makes sense. Then M. Saidu said, how many hours are we doing, please? Are you referring to today? Okay. Right, so I was mentioning something before Derek came up with his question. One of the things that you have to work on, and that I entreat all of you to work on, is the issue in relation to grammar, spelling, expression, and all of those things. Okay, Derek, you are welcome. Because it is interpretation, the examiner will be looking at your spelling. Okay, the examiner will be looking at your grammar. The examiner will be looking at other issues, expression, okay? And remember, there is always a professional marks available for presentation, so orderly presentation. So if your handwriting is not good, that is also something you got to work on, right? But if your handwriting is good, then you are going to be writing clearly well in relation to that. So in the interpretation, you've got to make sure you work on your spellings. I believe I've told you this already. Some of you, you carry the WhatsApp chats to the exam hall and you see there. People are writing there like this, that, then people are writing that like this. If you do some of these things, this is a professional exams. It will affect you in relation to that, because there is always a professional mark for the exams at the end of the day that will be awarded to the marks. So chances are there are times you may get 60 based on your marks, but you, at the end of the day, you will get something like 65 in relation to the, or 67. That extra 5 may be coming out from professional marks awarded to you due to your presentation, expression, grammar, orderliness. All of that is something that you may be looking at in relation to that. So that is it about the profitability ratios in relation to that. The next thing will be the liquidity ratio, liquidity and efficiency ratios. And I'll be looking at that tomorrow, God willing, for time's sake here. We will be having our Zoom sessions with our on-campus and online students. So I'll be concluding today on the discussion for financial statements, evaluating of financial statements. And God willing, tomorrow we will look at the part 2 of this, where we look at the liquidity, the efficiency, and certainly the investors ratio in relation to that. John Edu said, hey, handwriting problem. Why, John, do you have handwriting problem? Then you have to be very careful. Very fast, but poor. Okay, so you gotta work. Some of you write like together, like you are slanging the words, something like that. You gotta be careful in doing all of that. Make it clear. If you're writing something, write it clear. Like, let's see something visible, right? Like that. It's not that you're gonna be doing some corner thing. You see people doing a lot of things, making it clumsy in relation to that. So clarity is key, okay? Clarity is key in relation to that. So any questions for me? I'm going to be concluding here today, and God willing, tomorrow we will look at the part 2 of this, where we look at the efficiency, the liquidity, and how we merge all of them together. Samuel Quasin said, so in writing the interpretation 1, we define, state the norm, percentage change, reason for change. It is the way to go about it. Is it the way to go about it? Okay. When you say state the norm, Quasin, what do you mean? I don't understand what you mean by state the norm. It is not always that the issue about stating the norm should be in there. Yeah, you can define shortly. Remember, it should be brief, because you are not doing definitions here. You go straight to the point, and we want to look at what's happening. So yes, you can give a brief definition. This measures this. And then the percentage change come in. Then you state the reasons. Yes, this is what it should be. Then the implication, don't forget, like I mentioned, the implication could be done at the concluding part, okay? So when you put conclusion down, all right, the implication for the ratios could be covered there in relation to that. Okay, Samuel, I guess the norm you meant is the benchmark, that it is desirable that a higher, okay, I guess that is what you mean by the norm in that case. Miriam Kechali said, thank you very much, sir. You are welcome, Miriam. All right. So thank you very much for joining the stream. It's always a pleasure coming your way to provide you with some assistance. So shout outs to a couple of people: Obiadan, MCA, John Edu, Grace, Seidu, Kledos, Richard, Derek, Gabriel, Addison, Amma and Pim, Andrew, Opon, Beko, Foster, Patience, Juliet, Miriam, Basil, Isaac, Enyonam, Priscilla, Richard, Osei, Samuel, Wanani, Godwin, Florence, Mensa, Derek, Chira, Ura, Olanihi, all of you guys. Okay, Praise Ano, Samuel Kwasin, and all of you guys. Dennis, thank you very much for joining the stream. It's always a pleasure coming your way. So tomorrow we're going to be looking at the part 2 of this discussion. Remember, my objective is that the 10 mark on the interpretation, I am aiming for you to get 7 out of the 10, 8 out of the 10. Now, you don't say, hey, Nhyira, it's going to be difficult. No, I've told you the battle is won in the mind. So it's possible. All you must understand is the principles, the concepts, the technique on how the interpretation should go. Then you work on your grammar. So you got to practice a lot of questions and find out how you are working in relation to that. Now, don't be tied to the examiner's report on the interpretation, because sometimes the examiner's report is detailed. That doesn't mean that is what we expect you to go for. So let just that be like a guide for you. That doesn't mean that's how much you are supposed to write, because sometimes you want to write and you end up writing a lot of things you are not supposed to write. So go straight to the point. Tell us about what it is. Tell us about the percentage change. Tell us the possible causes, and then tell us the implication of what is happening. So it is in the implication that you can bring the norm, like what Samuel Kwasin mentioned in relation to that. Okay, so Obia Dan said, thank you very much, sir. Dennis, give a clap emoji. Basil, thank you, sir. You are welcome, Basil. Jonas said, thanks indeed, very helpful. Welcome. Augustine said, good night, guys. Augustine, good night and sleep well. Okay, so I'll see you same time tomorrow as we continue with the part 2 of this discussion. So same time tomorrow, and that's going to be still 4:30 p.m. in relation to that. Now, if you have any inquiry to make, or there is something you want to ask about, you can reach out at 050-114-9296, 050-114-9296. Maybe you have an inquiry to make, or you want to know about something, you can call or WhatsApp this line, and you will be guided or provided with any inquiry you need in relation to that. So thank you, and I'll see you same time tomorrow, 4:30 p.m. Remember to share the broadcast with others, and let's together reach as much students as possible.